Welcome back to the channel, everyone. Today we're breaking down the real story behind Plug Power. Far beyond the headlines, far beyond the hype, and far beyond what most traders see on the surface. While the stock continues to struggle below the key $230 to $250 resistance zone, the truth is much deeper than a simple lack of momentum. The market has been focused heavily on the company's latest financing move, which brought in $399 million in fresh liquidity and helped eliminate a first lien obligation. On paper, that looks like a clean win. More cash, less immediate debt pressure, those are all positives. But the surprising reality is that liquidity is not the biggest factor weighing on the stock right now. The true drag is dilution, specifically the forward-looking dilution tied to Plug Power's strategy, and even more critically, the proposal to increase the authorized common stock to 3 billion shares, a vote scheduled for January 2026. This single future event creates a massive psychological ceiling. No matter how many NASA contracts they announce or how many electrolyzer deals they sign, the overhang of dilution keeps pulling the stock back down to earth. Many investors, especially those aligned with the green energy narrative, continue to believe Plug Power is the foundational backbone of the entire hydrogen economy. They see a company that provides everything, from fuel cells to electrolyzers, from hydrogen plants to fueling infrastructure, and they assume the valuation must eventually reflect this massive future opportunity. They point to the new Georgia and Louisiana hydrogen plants, the long-term relationships with Amazon and Walmart, and the growing demand for stationary power as proof that the company is executing on a big vision. Add government support like the Inflation Reduction Act tax credits, and it forms a narrative where Plug Power looks destined to become a future green hydrogen utility. But the brutal reality, shown by the stock chart and daily trading patterns, is that the capital requirements, operating costs, and execution risks of this massive green hydrogen strategy are far larger than the market currently wants to support. Even though revenue continues to grow, gross margins remain negative, and net losses remain wide. That's why, despite positive news, the stock fails to break out. It isn't a demand issue for their products, it's a capital structure issue. Meanwhile, daily trading volume continues to hover above 90 million shares, signaling the presence of heavy short-term trading, aggressive hedging, and fast money. This is not stable, long-term institutional accumulation. This is tactical trading. The intraday low of $2.90 on Monday, followed by a late recovery, perfectly illustrates the tug-of-war between short sellers, day traders, and funds trimming exposure. This price action exposes a market divided into two camps. One sees Plug Power as a future energy infrastructure giant. The other sees it as a high-risk company burning cash too quickly, while repeatedly returning to the equity and debt markets for survival. Now let's talk about the recent December jump. The stock surged nearly 11% in the first week of the month after two genuine business wins. First, liquid hydrogen delivery contract with NASA, a letter of intent with H2Gen for a 5-megawatt PM electrolyzer project in France. Both are meaningful milestones. But the immediate selling that followed shows how the market views Plug Power. A $2.8 million NASA contract is prestigious, but it does not offset quarterly losses in the hundreds of millions. The November capital raise through convertible senior notes was necessary for liquidity, but almost every convertible note eventually leads to dilution. Institutions know this, and their recent 13F filings prove that investors are positioning themselves not for long-term certainty, but for volatility. For example, Jane Street Group, a top-tier algorithmic trading firm, reported both large share positions and large put positions simultaneously. This kind of multi-directional positioning isn't confidence, it's volatility trading, pure and simple. Now let's break down the business model because it's the core of both the bull and bear thesis. Plug Power has moved far beyond making hydrogen fuel cells for forklifts. The company is now building out a vertically integrated ecosystem, manufacturing electrolyzers, producing green hydrogen, liquefying, transporting, and distributing hydrogen, building fueling stations, serving large fleets and stationary power users. This ambition is enormous, but so are the capital needs. This shift from hardware provider to full-scale hydrogen utility is the main reason the company's gross margins remain deeply negative. Past reports from 2024 and earlier emphasized the same challenge. Scale was supposed to fix the cost structure, but instead the build-out costs continued to rise, forcing repeated capital raises. Now let's get to the most controversial topic, short interest. Plug Power remains one of the most heavily shorted stocks in the entire clean energy sector. The latest data shows over 305 million shares sold short, 23.2 float, days to cover ratio around 3.06, high enough to get short squeeze conversations buzzing online. This level of short interest means a massive portion of Wall Street is betting on further downside or questioning long-term profitability. Borrow fees remain low, under 1% annually, which shows short sellers are not under pressure to cover quickly. Retail investors frequently point to the high off-exchange short volume ratio, around 50% in recent reports, as evidence of manipulation or dark pool suppression. While that number looks alarming, the reality is simpler. Most large institutions and market makers conduct bulk trades off-exchange as part of normal operations. Still, the high off-exchange activity does confirm that Plug Power's order flow is complicated and highly institutional, not driven by retail buying. For retail investors looking for actionable data, the key metrics to watch are changes in short interest percent, borrow fee spikes, shares available to short, recently around 1.3 million, put versus call open interest. Historically, Plug's put open interest is high, meaning traders and funds continue buying downside protection or outright betting on declines. Now let's address retail sentiment. Online forums show a mix of frustration, hope, and a belief that Plug Power is being suppressed by hedge funds and market makers. Many retail investors point to the heavy short volume as proof of manipulation. But while short sellers are definitely active, they are reacting to the same core concerns. Negative margins, recurring dilution, high capital expenditure. The market is not fighting Plug Power's technology. It's fighting Plug Power.